Welcome to the Kickstart My Franchise podcast. I'm your host, Tim Michaels. On today's episode, we have John McCauley and Matt Schaffer from Preferred Funding Group. Welcome, guys.
Thank you. Yeah,
Thanks.
good morning. Thanks for having us on.
Love the sign in the background there. Any backstory there?
Yeah, you know what? It's from a carnival park in Chicago from 1903, and then an old man that does neon put neon on it, and I bought it from him. So
It's
it's
awesome.
a little piece of Chicago history.
It's a great background there. So,
Thanks, man.
the question I think most of our listeners have is, what is Preferred Funding Group and how can you guys help?
Yeah, so we're basically a funding brokerage. We do unsecured funding. Everything that comes to us is business owners that are looking for funding to either start up, grow, expand, payroll, whatever they're using the funding for. We don't have any restrictions on that, but they're using it for their business. So these are individuals that don't have collateral to put up. They don't have tons of cash in the bank. They don't have equity to share, or it's not an equitable enough business yet. So this is really kind of a middle ground that covers a very large swath of business owners throughout the country. We apply to a lot of people rather than a small niche market. So clients come to us and we get them funded based on the strength of their personal situation, and they're able to do whatever they need to do on the business end of things with that fund.
Got it. Okay. That makes a lot of sense. So let's say, a lot of my listeners are looking at potential franchise ownership. Let's say I'm considering a brand. Like, at what point in the process would it make sense to engage your company? Like, is that like day one? Is it not until the end?
Yeah, we work with a couple of the largest franchise coaching companies in the country. And so we're very familiar with the model. We love franchise clients. And to answer your question, we get them at both stages, actually. So we'll have a lot of clients that come to us when they're in the discovery stage or even pre-discovery stage of franchise. So they know they want to buy a franchise, but they don't know which one. And they haven't done all of the due diligence and all that stuff yet. So they just want to make sure, okay, I want to buy a franchise. Let me make sure I qualify for funding so that I know I can pay for the franchise, because that may be a hard stop for them, period. So they want to find that out before. So we have clients that come at that stage. And then we also have clients that come at the stage of, I've already done discovery. I've already picked my franchise. I've already done most of the legal paperwork. Now all I need is that capital infusion. And I have 3 weeks, 4 weeks, or whatever before I need that money to be able to execute on this contract for whatever the franchise may be. So we kind of get them at all realms. And that's just, I guess, because of who we work with in that arena, which would be usually like franchise coaches or some type of franchise consulting firm, someone that's helping franchisees pick and choose what franchise they're going to open and figure out the resources that they need in order to get funded, get legal prep work done, and all that good stuff. So, so to answer your question, we get them kind of at all stages.
Got it. Let's say I'm looking at buying a franchise. I've considered like an SBA loan. Are your products, is it an either or sort of situation? Are they complementary? Can I get both? Like, how should somebody think about that?
That's actually a great question. It's very much a both scenario, depending on the situation. I should say it's situational, but it can be both. It can be either or. So I'll expound on that. For SBA specifically, SBA is a great program. We can work complementary with SBA if the client gets the SBA first. So
Okay.
SBA is always going to be at least a few percentage points cheaper than us. Okay, so if a client comes to us and they say, "Hey, I've already had a soft approval for SBA," or "I think I can get an SBA," or "Someone told me I can get an SBA," we always push that client to go try to get that first, because it's not going to affect us in any way. So you'll be able to go get your SBA, maybe get 100,000 from SBA, whatever, just for simplification. So if you get 100,000 from SBA, right? You wrap that up, you close, it gets into your bank account. You can now come to us and maybe you get 150, 200,000 in addition to that from us. But what we can't do is vice versa. So we don't want to mess up your SBA, right? If you come to us first, SBA is so sensitive about inquiries, about other lending, about your debt exposure, that if you come to us first, you're going to shoot yourself in the foot with your SBA. So when we're dealing with franchisees specifically, and they come to us ahead of time and say, hey, I'm exploring all options, and I think I may be able to get an SBA. Okay, great. Well, I want you to explore that as far as you can, get a firm answer from them. And if it's a firm no from them, great, come to us and we're your next cheapest option. So it's a natural next step for you.
Yeah.
If you do get it and you still need money after that, you can still come to us. So
Got it. That makes a lot of sense. As far as like, is there a pre-approval process with you guys? And if there is that pre-approval process something that you still need to wait until the SBA is done? Or is that something that could happen before the SBA is done?
Oh no, yeah, we can pre-approve. Our pre-approval process is based on a soft pull of their credit. So we
Okay.
basically have the client soft pull their credit and send us 2 years of tax returns. And based on that, I mean, we have two programs, so we don't necessarily need. We have a stated income program that doesn't require tax returns. So I don't want to like bar anybody listening from applying with us if they think, oh, my tax returns are no good. Still apply with us because we have a stated income program. So, but generally speaking, what we ask for is give us a credit report and give us 2 years tax returns. Even if they don't reflect the income you think they should, that's okay. And then we look at that information and we say, okay, based on this is what we can do. Nothing's happened yet. You haven't gotten an inquiry. You haven't committed to any funding. We're just saying this is a dollar amount we can do for you based on this soft pull of your credit and this quick glance at your financials. And then many times when we're dealing with franchises ahead of discovery, they'll take that as basically like a piece of armor to then go and say, okay, well, I know I have this bird in the hand over here. I know for sure I can fund this startup franchise. And now let me go see if there's any other better options. And we kind of love that because we're the third cheapest option in funding period. So in the category that we're in, first cheapest option is always going to be collateral based lending. And this is generally how franchise guys, coaches and consultants, this is generally how they go through the order of things with clients. So they'll say, okay, well, you want to start a franchise. That's great. What do you have equity in your home? Yes, no, whatever the answer is. Okay. If they say yes, okay, they'll try to explore collateral based lending first because they know that's the cheapest option.
Yep.
But with that comes, well, you better believe in what you're doing because you're leaning on the value in your home. You're collateralizing your home.
Yep.
Or some type of tangible asset, whether it's a rental property, whatever. So you'd be surprised at how many people do not want to do that. You'd be surprised at how many people with paid off homes, because a lot of franchisees are surprisingly in the older category of whether they're retirees or almost retirees and they just want to diversify their income or do something in retirement that's just a little bit easier and a little more passive, whatever the case may be. So we'll get a lot of people that come into us that are looking to open a franchise and have paid off homes and say, even though that's the cheapest option, I don't want to mess with my home. Or same with like ROBS, like liquidating your retirement or you levying your retirement in order to get funding for your franchise.
Yeah.
We run into people literally on a daily basis that do not want to do that. They deem that as more. They want to separate. Okay, well, I work my whole life for this. I work my whole life to pay off my house. I work my whole life to build my retirement. And what I'm doing here is like a new venture, and I'm not 100% sure about it, so I don't want to risk anything. That's where we come in. So collateral base is your cheapest option. Then comes SBA. SBA is the second cheapest option of funding available. Then comes us. We're unsecured lending. Now we're only dealing with 8 paper clients, so we're limited in that. But we process 15 to 1,600 applications a year, so we're dealing with 15 to 1,600. We're really dealing with 5,000 to 6,000 people with 700 and above FICO scores a year, but 15 to 1,600 of them end up processing with us. So we're dealing with paper clients, highly qualified people who understand, okay, well, what I want to do is I want to leverage, I worked my whole life to build my credit and my income in a responsible way. And I now want to leverage that to get funding for my business that's unsecured, that doesn't have that recourse of, okay, if you don't pay, we're going to take your home. If you don't pay, there goes your retirement.
Mhm.
So we're actually, in my opinion, way more appealing to franchisees because you're leveraging something that is a lot less risky on your end than putting up some collateral that you spent your whole life paying off or risking half your retirement to
Yeah.
open, a franchise that is a totally new realm for you. You have no idea how it's going to work out. So
Yeah. So if I open, let's call it a Jimmy John's or something, and I take a loan from you guys, and for whatever reason it goes belly up, what do I still owe? How does that work?
So you still owe.
Yeah.
There's no just like evaporating debt, unfortunately. But
Too bad.
what I know. Well, you never know. We don't know nowadays. I mean, but what happens is what you want to focus on is recourse. What's the recourse? And no one ever has an intention of defaulting. That's
Right.
never the intent, obviously. But if you're trying to calculate your risk, what you want to focus on is, okay, well, what's the recourse? I can't control everything. If something goes terribly wrong and I lose the ability to pay, what happens? Collateral based lending, you lose the asset. A Rob's rollover, any type of levying of your retirement assets, you lose that. So you lose your retirement, you lose your vested interest in your retirement. And then with your SBA, they can go after your assets because usually it's tied to your assets or they've listed your assets as appropriatable, like they're able to go after your assets in worst case scenario. Unsecured is the only recourse is your credit's going to be damaged,
Yeah.
and that sucks. Like you don't want that, but if that's worst case scenario in a really dire situation, that's usually in people's minds. That's a lot better than losing their home
Yeah,
or
absolutely.
losing their retirement, because then they think, okay, well, if this business doesn't work out, I can figure out how to pay it back. I can figure out how to fix my credit, but I'm not losing real things. I can still retire comfortably. I can figure this out. Um, so I think that's why we're usually much more appealing to specifically to startups, to people that are just jumping into something. But we really do. We cover a lot of ground as far as businesses. We're probably the most marketable type of funding in general to business owners, unless they need a crazy amount of money, and then we're 50K to 500K. So that would be considered like small to mid cap. And if someone comes and says I need 5 million, well, we don't do that, and it's that's just a very hard amount of money to get.
Yeah.
So
Yeah.
we wish them the best. If you need help with a smaller amount, we're here for you. Down payment money, whatever, um, to get bridge money to get to that bigger money, we can help you. But we stay in our lane as far as small cap, startup, mid-size, growth, expansion, payroll, POs,
Yeah.
what.
For these unsecured loans, like what is the typical length? Like how many years are these?
5 or 7 years. It if sometimes if a client wants to get the lowest interest rate possible, we can offer them a 3-year. So if somebody's really rate conscious and they're like, hey, um, I'm only going to use this money for a year anyway, so I want the lowest rate possible. Then we'll just give them a 3-year, and it will drop the rate significantly. Usually they'll get 3 options. It'll be, okay, well, here's your amount is the amount. Okay, that's not going to change. But what will change is, here's your option at, let's say it's 100 grand, right? You get 100 grand at a 3-year term at a 7% interest rate, and here's your payment. Or you can take option B with 100 grand at a 5-year term with a 8.5% interest rate, and here's your payment. Or if you want to really drag it out, if you care about having more time and a smaller payment, here's 100K at a 7-year term at a 9% interest rate. Here's your payment. So we'll run that by the client and say, what would you prefer? Do you want a longer term, or do you want a shorter term and a lower interest rate? Longer term, higher interest rate, shorter term, lower interest rate.
Got it.
And payment will fluctuate as well.
Yeah, and I just wanted to chime in real quick. So also with these loans, there's no prepayment penalties. So, most of the clients that we work with do opt for the longer term, 7-year term. And then if they pay that off early, they're just saving, on interest. So yeah, that's really, a good advantage for our programs too, is that no prepayment penalty.
Yeah, no, that's a great point. I did not know that, so that's helpful to know. You guys also do some credit cards. Is that correct? Can you talk to us a little bit about what those programs look like? What's a good use case for somebody to use one of those?
Yeah. So there's 2 programs, just to clarify. We have a cash option, which
Okay.
is our term loans. That's what we just discussed, 5 or 7-year term loans. That's just cash deposited in your account. It's literally a signature loan. So very minimal paperwork, 2 weeks to process, cash deposited in your account, no restrictions on use, traditional monthly payment, traditional APR. Totally cut and dry, very, very traditional. And the other program, it used to be 2 things. So, and it still is, but the checkbook line of credit, which is what everybody is mostly familiar with, which is an account where you can draw cash from, and it's like essentially like a home equity line minus the home.
Mm,
So it's a traditional line of credit with an account. You can pull money out. You have check writing capabilities. That used to be our line of credit. It still is. It's very hard to qualify for because the term loans came out. So once banks started offering term loans, you saw the line of credit go away because the line of credit was heavily in the favor of the consumer, not the bank. It was the best of all worlds. It only reported to your business. It had cash and credit capabilities. You're only paying for what you're using. And it was just really heavily in favor of the consumer.
yeah.
So when they came out with term loans are heavily in favor of the bank because it's a monthly payment. It's not a pay as you draw situation. It is a monthly payment from the beginning. So you're not just waiting on that first draw to make a payment and then you're only paying on what you're using. You're paying from the total amount. You're paying on the total amount from the very start. You have your fixed APR and you have a time frame. So rather than saying, hey, this is just open in perpetuity until you don't want to use it anymore, you have 5 or 7 years. And the big difference is the term loan, whenever you're getting cash that's unsecured, they want it to report personal. So yeah, you're getting money for your business, but they want it to reflect on your personal credit as installment debt, which is a good thing. It makes your personal credit stronger. What you want to avoid is revolving debt on your personal credit. So that's our next program, which is the business credit cards. Those are just typical. It's a credit card stacking program, but we use it as a supplementary program. So usually it's clients that get the term loan, and then they say, okay, well, if you can get me 2 or 3 cards as well, high limit cards at 0% interest, I'll take those. So the benefit is, as a supplementary program for us, it's okay if we can get you 3 cards, let's say at 25 grand a piece, 40 grand a piece, and get you a big chunk of money at 0% interest, only reporting to your business credit, not on your personal credit.
Yeah.
It's not going to affect your personal credit. And you can use those for any aspect of your business. It's a huge bonus in addition to the cash you're getting. So,
Mhm.
and on the flip side of that, if a client only qualifies for cards, well, that's fine. I mean, if if there's ways you can use it in your business, great. If you can swipe your cards for supplies, um, marketing, paying contractors, whatever you can swipe your card for, get that debt on your business, not on your personal. You take advantage of the 0% interest for the first year, and pay it off within the first year. Or the other benefits of the cards is you're only required to make minimum monthly payments, which is typically 1% of what's being used, and even that typically has a cap of like $500. So if you got 100K in cards and you're using the whole thing totally maxed out, 100 grand, it's $1,000 payment. Whereas 100 grand in term loan money would probably equal $1,600 payment.
Yeah.
So there's going to be a difference in payments. So it's all strategy, and there's ways to get cash out of the cards as well. So if somebody only qualifies for cards, which is the stated income program I mentioned earlier. So if you don't have income, if your tax returns aren't um, what would qualify for our term loan program, which would be 50,000 or more in personal income the past 2 years and a 40% or less DTI. If you don't meet that criteria, but you still have 700 and above FICO scores, you still will likely qualify for the card program. And then if your ultimate goal is to get cash, we can walk you through how to get cash out of the cards and all that good stuff. So
How is this impacted? Like, let's say I haven't worked for whatever reason for the last 6 months, but I have a spouse that has like, are you allowed to like combine things, or like how does a spouse play into this?
yeah, in marriage situations, yes, we can do a joint application. Um, so two things. If you're married, we can always do a joint application on the term loan, and we can actually run you separate for cards. So you can really get a lot of bang for your buck on the card. So in a situation where somebody says, "Hey, I need as much as possible," um, we will typically say, "Okay, you qualify, your wife qualifies, so we'll run you for cards separate. So maybe you get 100 grand in cards and you get 100 grand in cards, and then we'll run you for the term loan together um, on a joint application, so we can combine your guys' income on one application and get the maximum amount of term loan funding possible." So, yeah, it's very advantageous to bring in your spouse. We usually that's like a default for us is
Yeah.
to say, "Hey, what about your husband? Hey, what about your wife?" The other thing to mention here is that we're able to use cosigners. So, in an event that a client sends us a credit report and tax returns, and we can't qualify for either program, we immediately go into, okay, well, do you have any potential cosigners? And we try to take that like no stone left unturned method of, well, let's make sure that if you don't qualify, you don't have someone around you, business partner, um, a spouse, a friend, someone who would lend their credit to you as a cosigner in order to get your business funded. And the benefit of that is, again, the funding is only going to report to the business. So it makes it a lot easier to have that conversation with a cosigner, potential cosigner, to say, look, I need you to do this for me, but it's only going to report to my business, so it won't even be on your personal credit.
Yeah. No, that's a
So
great
we
point.
deal with a lot more than you would think. I would say cosigner files. It's something we deal with on a daily basis.
Yeah, no, that's great to know. Let's say I'm in a situation I want to get pre-approved by you guys, or what's the process? Does it take a while? Like, is there a form? Like, how does that work?
Yeah, so the pre-qualification process is very simple. Like John stated before, really the only documents we need for pre-qualification are going to be the 2 years of personal tax returns, and then we have them provide a full credit report from either Experian or myfico.com, and then we get them pre-qualified just based off of that soft credit pull. But typically, if an application is submitted during working hours, the client will receive a pre-qualification that same day. So yeah, I mean, it's very fast. The application process is super simple. Like I mentioned, just those 2 documents, and then their basic contact info is really all we need to send out a pre-qualification. And then, yeah, we send out a pre-qualification via DocuSign for the client to review. And if they want to move forward, that'll include the full application, which is some more details that we're going to need for the underwriting process.
Fantastic. And if they actually want to move forward, go ahead and do this. Can you talk a little bit about like how long that typically takes?
Yeah, so I mean, once the client, receives the pre-qualification via DocuSign, they fill out the application and provide the supporting docs. We'll put them into underwriting, and then the underwriting process typically takes 7 to 10 business days. Once the underwriting process is complete, that's when the clients receive their funds. So typically, from start to finish, our clients are, applying and getting fully funded within 2 to 3 weeks.
Yeah, and I mean, so that's super, super quick relative to like the SBA loan process, which is multiple months or more. So that's great. Yeah, it looks like
That's
you got
actually,
something.
well, I was going to say that's actually another piece of feedback we get a lot. We work very closely with a ton of SBA companies and a ton of SBA brokers across the country, um, and we get a lot of clients directly from SBA for that very reason. So rather than turning a client down or being a dead end for a client, a lot of SBA brokers, a lot of even direct SBA banks will use us as a resource to say, hey, well, if a client comes in and says, hey, I need an SBA, and they say, okay, well, you're qualified, you qualify, and then they get a couple days into the process and realize, oh, this is going to take 45 to 60 days. I need the money yesterday. You know what I
Hmm.
mean? So we're we are a lot more nimble as far as processing time, and we're inside of 2 weeks, um, majority of the time. So it's a natural pass off from SBA to send clients to us and say, "Hey, this guy couldn't wait 60 days.
Hmm.
Get him
Yeah,
funded, take care of his immediate needs, and maybe we can work with him in the future." Um, and that's why we're such big advocates. If somebody comes to us, vice versa, and says, I think I can get an SBA. Okay, great. Explore that option. Come back to us. But that is the big differentiating factor between us and a lot of other funding companies is how quickly we process while still being a very traditional type of fund. You know, I would I would definitely be wary of anybody who says, "Hey, 24-hour funding." That's not a healthy time frame.
yeah,
Typically, that means it's not great funding because they want to get it to you before you change your mind. But 7 to 10 days, or even 7 to 14 days of funding for us to be able to get traditional funding that is a low APR, that is a great term, that's going to help your business rather than strangle your business. That's really our competitive advantage in the realm of why we apply to such a large amount of people. Um, in comparison to like most types of funding it's very niche. It's a very specific criteria. It's a very specific industry, specific type of funding, or specific type of client. We're very broad. We're
yeah.
everybody. You open a business and you got good credit, come on. We don't care what kind of business it is. We're not going to restrict the use of funds. We're just basing this solely on how responsible you are as an individual.
Yeah, and that's kind of why we're able to process a lot more quickly than the SBA also is because we're just looking at the individual strength of credit individually, income, debt to income for that individual. We don't need to see business plans. We don't need to see projections for the business. We don't need a write up of how you're going to be spending every single dollar. It's very simple personal documents for the underwriting process. Nothing complicated, business related wise. So if you've, established strong personal credit, you have the income to support additional debt, that's what we're really leveraging to get the client funded. And then, like John said, at the end of the day, it's just a signature loan, based on credit worthiness and income. And, our clients put those funds to use, whether that's to expand or start up a franchise.
Yeah, and
Awesome.
that's honestly that's the big advantage too, is that specifically, I'll curate this specifically for franchises. If you're a franchisee or a potential franchisee, and you're looking into, okay, I've worked my whole life. I have this, and I'm just saying this because this is like a pretty typical scenario we run into. Somebody wants to open a franchise. They've worked their whole life in XYZ job, right? They have a career, they're nearing retirement. They just want to diversify a little bit and get a little like maybe even passive income coming or just something different, to diversify their income and add to the pot. A lot of times these people come to us and they still have jobs, which is incredible for us, but not so incredible for other types of funding. So like if you go to the SBA and you're opening a business and that business is zero revenue, pre-revenue,
Yep.
you don't even have a business plan. You're just, hey, maybe I'm going to open this franchise, and typically they won't even touch you. Most of the time, most SBA banks and brokers will not touch startups. There's a select few that will work with startups, but it's very rare, very difficult, very small amount of money for a mountain of paperwork that you have to provide and tons of flaming hoops you have to jump through. So when they come to us, they see very quickly that we don't need you to have a business plan. We don't need you to, I would suggest it, obviously, but we don't need you to have prove your financials on the business or have 2 years of business tax returns or a P&L or all these things. Those things are great. There's nothing wrong with that. But when you're opening a franchise and hitting all these dead ends, this person won't fund you. This type of funding won't lend to you. And my favorite misconception is I have $1 million in my personal bank. I've been banking with them for 50 years. And I walked in there and told them I need a loan. And they said, no way. That I hear that every single day. So that's a huge misconception. And someone's trying to open a franchise, hitting all these dead ends. And then they come to us and it's a very simple process of just, hey, is your personal credit strong? And let's see your personal income. Oh, you still have a W-2 job? That's amazing. Because that's the most stable income possible to a bank, and we're going to lend based on that. So the fact that you still have that W-2 job is a good thing. So use that, leverage that in addition to your personal credit. Let's get you funded for your business. And then if your business develops in a way that you quit your job, you've already gotten your funding. So it's great.
Yeah.
You leveraged it while you had it.
Yeah, no,
So
it's fantastic.
that's something we run into quite a bit.
Awesome. I think that was all my questions. You guys have any last like nuggets or things you want to get in?
No. I mean, unless Matt does, we personally love franchises. I would say don't let anything. I always say this, but don't let anything in this video disqualify you in your mind. When you go over a lot of stuff, I feel like sometimes clients will say, "Oh, well, I don't meet that criteria," or "Oh, that doesn't apply to me." I always tell people if you're 680 and above credit, just submit. And at the very least, I can give you, or Matt, anyone in the office can give you a solid blueprint of what you should do. And we know a lot more about, we take a very white glove approach to funding. So rather than just saying yay or nay, you either qualify or you don't, we take a lot more of a curated approach to your specific situation. So if you're in franchising or you're a franchisee, great. We work with you literally on a daily basis. We know an unbelievable amount about franchising, about processes, about the companies out there, and we may be able to help more than you could imagine. So it's not just funding for us. We're not just saying, hey, you qualify or you don't, get out of here. We're going to take that time to approach you as an individual and say, okay, well, here's your situation, and yeah, you qualify. Here's how much, and here's how to get to this bigger number, or whatever. We'll put a roadmap together with you and really try to work with you for the long run, rather than just a simple transactional approach in and out.
Yeah.
Yeah, I mean, a large portion of my role is really just being an educator. So, working with clients, explaining to them our programs, answering questions, going through scenarios, what if scenarios, going over their goals and how we could help them get there. So yeah, I mean, I'm always happy to hop on the phone or, start an email chain, really just fulfilling that role as an educator, answering questions and giving the client as much information about what we can do for them as possible.
Fantastic. Well, appreciate both your time. Really enjoyed the conversation. I learned a lot, so hopefully our listeners did as well. But yeah, everybody should reach out to you guys. What's the best contact if people want to reach out?
Yeah, so I mean, they could reach out to me directly. My email is just Matt, MATT, at preferredfundinggroup.com. My cell number is, what I work off mostly, and it's 847-513-4818. Yeah, I mean, feel free to give me a call, shoot me an email anytime, and yeah, would love to connect with anybody who has questions or is interested in exploring our programs.
Awesome. Got to trust a guy who will give out his cell phone on a podcast.
We could probably put those in the links below or something, right?
Yeah, absolutely. I will. Absolutely.
Awesome.
Appreciate both your time here, guys. Thanks for hopping on.
Yeah,
Thank
thanks,
you.
Tim.
Thank you for
Appreciate
having
it.
us.
Yeah, have a good day.